Welcome back to the fourth in a series of videos that explains how to complete the financial statement and analysis system spreadsheet. This spreadsheet is part of the University of Wisconsin Division of Extension's Farm Management Pulse program. The curriculum and the spreadsheet itself can be found at the link shown on the visual. My name is Kevin Bernhardt, and I'm both a farm management specialist for the University of Wisconsin Division of Extension's Farm Management program, and I'm also a professor at the School of Agriculture at UW-Platteville. This video introduces and explains how to complete balance sheet schedules D and E on the value of inventory. Valuing inventory is one of the most challenging parts of the balance sheet. One reason for that is that there are many different kinds of inventory, and we'll explore that a little bit in just a second. Second, some inventory ends up being an accrual cost adjustment, while other inventory ends up being an accrual revenue adjustment. So again, different kinds of inventory. And finally, there's some inventory that is raised, born, grown on the farm, while there's other pieces of inventory that we actually purchase. So they all are treated a little bit differently for the reason that they are different. So that makes it a little bit more challenging. Let's get started. Let's look at the many different ways that inventory can be for the same product. Let's just look at corn. Look at all the different ways that corn can be in inventory. It could be raised corn that we have stored and we want to sell it. We have the intent to sell it. We could have raised corn that we have as an intent to feed it to some livestock. So that's two different kinds of inventory. One of them we're going to sell, one of them is an input, but they both were raised on the farm in that case. We also might have purchased corn that we have in storage on the date of the balance sheet that we have the intent to feed. So that could be a different kind of inventory, but it's still corn. We could have corn that's commingled. So we could have raised corn and we could have purchased corn in the same storage bin, or we could have corn that is in the same storage bin where part of it's meant to be sold and part of it's meant to be used for feed. So we have a commingling issue there too that we can wrestle with. And finally, we could have corn that's still growing out in the field. It's an asset. It's a value to the business if the business were to close down today. So how do we value that if it's still outgrowing in the field? It maybe looks like it's valuable today. We could have a hailstorm and it's worth nothing tomorrow. So how do we value a growing crop? These are all issues that we want to try to deal with. So this is the visual shows sort of a cheat sheet, if you will, of how to value different kinds of inventory and also, quite frankly, which schedule to put it in. So we haven't looked at the schedules yet on the spreadsheet, but when we do, there's two schedules. Schedule D, if you look in the far left side of this visual, Schedule D, and it's broken up into different categories of D1, D2, and D3. And then there's Schedule E, which is also parts E1, E2, and E3. So each one of those different sections in those two schedules is for a different kind of inventory that may indeed be valued a different way. So for example, in Schedule D1 is for recording any inventory that we raised ourselves on the farm. So great examples of this, of course, would be corn, soybeans, pigs or cattle that were born on the farm that we've raised ourselves and so forth. And the Farm Financial Standards Council recommends that if we have the intent to sell those raised products, then as of the date of the balance sheet, if we have those on hand, we should value those at market value as of that date. In category D2 is also raised or born products that from our farm that we've raised ourselves. But instead, we have the intent to use them as an input into another production process. So crops is an excellent example of this. Crops and forages that are raised with the intent to use them as a feed use. Farm Financial Standards Council would suggest that we use market value for that one as well. Argument can also be made to use cost of production for that particular one. And that's what's recorded here. And we'll talk about that more in just a bit. Category D3 is for anything that we've purchased but we have the intent to add value to it and then sell it later. So an excellent example of this is purchasing feeder livestock, adding value to it to a market size, and then selling it. Farm Financial Standards Council recommends market value in that case. Schedule E is for things that we've purchased, and they're all things that we purchased with the intent to use as an input. They're all valued at cost, whatever the cost of that item was, and we will talk more about these in just a moment as we get to the spreadsheet itself. Let's go to the spreadsheet, and let me go down to Schedule D. So there's Schedule D. Schedule D is for all sort of revenue generating inventory that we have, and it's in those three categories, D1, D2, and D3. So let's start with D1. D1 is products that we have raised or products that have been born and we've raised them on our farm. This would be either crops or livestock that we have the intent to sell. So what our intent is important here as to how we might value it. So we can see Wisnet Farms has some soybeans in storage. The unit description, it's in bushels is how we want to describe those. And units of inventory, we have 1,000 bushels. And right now, the market value of those soybeans is $12. $12 times 1,000 is $12,000. If we had more, then those would be added up here as we go through. In fact, let's put another one. Let's say that we also have some feeder cattle that were born, calves that were born on our farm. And currently we have 10 550-pound feeders that are worth $1.40 per pound. All right, so the description of the units here, we're going to look at head, what they're worth per head. We have 10 of them. The number of head we have is 10. And the market value per unit is that $1.40. In this case, we have to do some multiplication. So if we take $1.40, multiply that by 550 pounds, I believe that's $770 total, giving us $7,700 worth of feeder cattle. So now we add those two up together. That's 19,700. That 19,700, when added with categories D2 and D3, will give us our total. Let's go to category D2 now. Category D2 is inventory that's been raised and grown as well, but it has the intent to be used as an input into another production process. So in this one, you can see they're all added for Wisnet Farms. We have some hay, some corn silage. The units are noted. How many units we have in inventory are recorded. And we have a choice here to either use cost of production or to use market value. Now, this is a challenging one. Farm Financial Standards Council recommends that we use market value. But some people will say, well, wait a minute, why would I use market value? That's the reason I'm growing it in the first place, is to have a cheaper feed source. So it kind of depends on how you look at it on your farm. If you look at the raising of those feeds and the cattle that you're feeding them to and so forth, all as part of one enterprise, it makes some sense to think of it as a cost of production for those feedstuffs. However, if you think of it from an opportunity cost standpoint, then you could have sold those crops potentially. And so you want your cattle or your pigs or whatever you're feeding them to, your dairy animals, you want them to cover that opportunity cost as well. And in that case, you would use market value. So the important part here is stay consistent from year to year, which way you want to use it. The cost basis and market basis are automatically calculated for you, as well as the totals, which will eventually be transferred to the balance sheet. Category D3, we don't have anything there right now, but that is a category where we have items that we purchase, and then later on we're going to sell them. So for an example, perhaps we purchased a 600-pound or a 500-pound feeder. We didn't grow it. We purchased it, and we're going to add value to it. We're going to put it in the feedlot, add some value to it. Well, if it's been here for a couple months, then its value is certainly a lot different than what its cost was. So we do want to use market value in that case. Okay, that's it for Schedule D. Let's look at Schedule E. So Schedule E is also for inventory, but Schedule E is for inventory that's ultimately going to end up being an accrual cost adjustment. So that's why we separate it out. Category E1 and E2 are really basically the same thing. It is inputs that we either have on farm or we've prepaid for some inputs that we're going to use in some production process. They're all purchased. The only difference in categories E1 and E2 is that E1 is for items that we're going to use as a feed input, and E2 is for items being used as a crop input or some other kind of enterprise input. And the reason for doing that is just to be able to give the livestock folks a chance to separate out that feed cost. Category E3 is also a purchased input, but this is for purchased inputs that haven't come, that are out on the field and the crop hasn't been harvested yet. So this is that situation when we have a growing crop. How do we value something that's a growing crop? Certainly there's a value there. If we were to close out the business today, which is what the balance sheet shows, then there's a value in that growing crop. But if that crop was planted 2 weeks ago versus that crop that's about to be harvested, those are two very different potential values. And yet both of them could end up suffering some big weather event and never be harvested at all. So how do we deal with that? Farm Financial Standards Council takes a very conservative approach on this and says there's one thing you do know, and that is the cost of the inputs that you've directly applied to that ground. So this would be things like seed, fertilizer, chemical. We're not going to include indirect costs like labor and depreciation and things like that. We're only going to include direct cost, i.e. those products, those purchased inputs that are actually out on the ground. What is the value of those? So it's a conservative value, but it is a consistent value for that growing crop. That does it for schedules D and E. Certainly one of the more challenging parts of the balance sheet. The next video will cover schedules G and H, which is for raised and purchased breeding livestock. This also bounces us into a new category of assets that are referred to as capital assets versus the market assets that we've been covering so far. But until then, thank you for listening.